Hello guys, how you doing? Joshua Mangu here, and I'm following up on a serious presentation about shares and the secrets about shares, why they're so amazing when everyone wants to go into the shares market. They want their shares to go public, in an IPO. So what happens is that, like I said, the share is like a title deed in a piece of land. Okay, or it's a license or an ownership in a piece of land. So in our example, it's one share for $1. Okay. So now I'm going to present to you why people want to have an IPO, an initial public offering. Don't worry about that. You can text me, you can call me, then we can talk about this in detail. So what happens is that when you want to raise cheap or affordable debt, alternatively to financial markets, and a bit more sustainable debt, is you have an IPO, initial public offering, in the primary markets. Okay, so MK is markets. So you need an investor also, like banks, hedge funds, and all that kind of thing. So in the primary market, it will be the first people who you sell to this one share. Okay, it's just an example, but people sell millions of them. Okay, so what happens is that they will buy it. Okay, it's worth $1. You want $1 for it. Okay, they will buy it at $2. Okay, at an affordable price, $2. So this $2, okay, is gonna go to the company. The company as capital, cheap debt. Okay, they'll buy it for $2, the first one. Then they will go into the secondary markets. The secondary markets is where financial instruments or contracts are bought and resold several hundred or millions of times. Okay, even several hundred times in a second, milliseconds, because they have been publicly traded, and we want supply and demand to decide the real price, the real value of your market in the market, and it's usually intrinsic value, how people feel about your company. So in the secondary market, this investor would like to sell it maybe for $4. Okay, let's sell it in secondary markets for $4. Okay, and that's what makes your graph when you're trading. Okay, so obviously it's not straight. That's what makes your graph when you're trading. But what happens when it sells it for $4? You subtract 4 from 2. His profit is $2. So what do we have here in this capitalization system? There's $2 for the company, and there's $4 for the investor. So this $2 is going to the company. It's never coming back. This has got nothing to do with this. Okay? But sometimes it can even go up to $8. So this investor is talking about $6 profit. Very good thing, but this is good, and it's based on how good the marketing is done, how good the dealers and the traders and the brokers do their thing, and how they market it, and most importantly, the value of your company. How does your company look? How do you do business? Is there high rate of potential? Is it providing or solving a problem? Okay, so this is amazing. So you find like Facebook has got what, 30 to 40 billion dollars in assets, but it's a $1 trillion company. So this is amazing. 30 to 40 billion dollar assets, but it's a $1 trillion company, because based on the problems that it solves, on the need for it, on the value for it. Okay, but this is where now shares become very scary, because if things go bad or go south, or people don't believe in your product anymore, like Kodak and all these, and all these old companies, or calamity strikes, your market value can actually go to zero. Because guess what? This money is gone, and this money is gone. But if you're doing it right, and that's why they're highly regulated by SEC, Securities and Exchange Commission, and good financial auditors, things will not go as bad as this. And most of the time, they might even rebound. So this is a very good secret. It's something that investors can use. Remember, some people have got companies, limited companies which are registered by shares. You can actually bring in an investor based on your shares, because your shares are based on the value of your company. Thank you so much. God bless.